No mai haru mai. Welcome to the channel. My name is Edia. If you've been enjoying the content so far, continue to like the video, subscribe for more, and if you have a friend that might find value in the videos that I provide, feel free to share the knowledge as we work closer to build a community for likewise Kiwis. Now today we're going to be discussing the difference between ETFs and shares. So let's get our hands dirty. An ETF, or exchange traded fund, pull together money from investors and then invest that into a diverse range of investments like stocks, bonds, and other securities. This can help balance risk by providing a wider range of diversification. Now, because they are listed on the stock exchange, they are bought and sold like shares. And just like there are a variety of mutual funds, there are also a number of ETFs too. Now, unlike a share, an ETF is not a business, therefore tries to mimic the performance of an index, giving you ownership of multiple companies, but still only owning one. So it does all the thinking for you. Now let's compare the similarities and differences with the types of funds there are. These are the definitions of each fund. Keeping in mind they are all similar types of investments, it's how they are managed which separates them. An index fund tracks the market index. Typically a mutual fund is less passive than an ETF, and a managed fund may adopt a dollar cost averaging strategy, which is when you day trade at different times of the day to take advantage of daily price drops and risk daily price increases. Therefore, an ETF is more flexible and convenient and can be traded throughout the day, whereas an index, mutual, or managed fund trade at market close. Like a mutual fund, an ETF is managed by an asset manager who will then invest in the stock exchange according to the fund's vision or values to ensure the shared goal is met. Now, if the investment goes well, then more people invest, and the more people that invest, the higher the share price goes. A common goal or purpose of a fund is to help with growth or to attract more investors. Now, keep in mind, you are the only one that can understand the level of risk that you are comfortable with, how active you want to be in the market, because time is a commodity we cannot buy more of, and what values are important to you. Now, and most importantly to me, the bottom line is the market should not dictate how you invest. So if something is on the rise or on the decline, this shouldn't change your why. If you are currently a user, go ahead and log in as you normally would. If you're new to Sharesies, register for an account and use my referral code to receive a $5 investment starter. My referral code will also be in the description below. Now you've logged in, select Invest, and we now see this view with the recent update. If you have not already, please see my previous video with the launch of US stocks to the platform. Let's see all and start in our own backyard here in New Zealand by selecting NZX, ETFs and managed funds. Now keep in mind there are no managed funds currently listed on the NZX, but this will provide you with a list of all ETFs and managed funds on the NZX. Now notice there are only two fund managers on the platform, being Smart Shares and Salt Funds. By way of background, Smart Shares is a New Zealand-based fund manager established back in 1996. Salt Funds is one I am actually unfamiliar with, but like fund managers on Wall Street, this fund's philosophy centers on the belief that the New Zealand and Australian share markets have characteristics that lead to market inefficiencies that can be exploited over time to deliver superior risk-adjusted returns. Simply put, like McDonald's, they believe they have a superior burger compared to their competitors. Now, browsing over Smart Shares ETFs, you notice that they'll have different names. Like I said earlier in the video, a fund will have its own purpose or goal and strategize their investments accordingly. So let's look at Smart Shares US 500 Fund, which is the most recognized fund as it tracks the S&P 500 index. Similar to the description I gave earlier, invest in the top 500 companies in the United States. This index is managed by Vanguard, one of the world's largest investment firms. We'll get to that soon. US 500 funds invests in the Vanguard S&P 500 ETF, which is an index fund. This means you don't own shares in one particular company, but units in a fund of 500 of them. This helps keep your portfolio diversified so you don't have all your money riding on one company. Now at the bottom of this fund, it'll also show you the risk level, which we mentioned in the previous video. So again, understanding what you are comfortable with. If we select buy, Just put in $1. Hit review. It'll come up with their product disclosure statement. Now, the reason you have to accept this is because it is a contract outside of Shares' standard terms and conditions you need to consider before buying. With the biggest one, yep, you guessed it, fees. Here it shows an establishment fee of $30. Luckily, Sharesies allow us to avoid the charge. See how difficult it was to invest before platforms like Sharesies, Hatch, or Stake came along? Now, based on your share value, a percentage will also go to the fund, which is how they make their money. Whoa. Let me get that straight. So the company, let's say Google, is in the S&P 500, which is owned by Vanguard, owned by Smart Shares, owned by Sharesies, and owned by you? Talk about inception. But don't let that discourage you. Like everything in life, nothing is ever that easy. Now let's quickly browse over the NASDAQ and the New York Stock Exchange. So you can see there's a lot more. Vanguard, which we mentioned earlier, is one of the larger fund managers in America. They have different and more variety when it comes to fund manager options with iShares, Vanguard, First Trust. So more options sometimes can be a good thing. Now if we go back to New York Stock Exchange, show all their funds. Again, they will show more managing fund options. What I want to check out is highest price over the last year. This really stamps out the myth that ETFs, index funds or managed funds, only provide a yield of 4 to 5% in the last 12 months. Yeah, it's a lot more than that. So there you have it, a beginner's guide to understanding everything ETFs and funds under management. At the end of the day, there's no right or wrong, better or worse, when we understand the difference between ETFs as opposed to owning one share in the company. Now, what type of investor would this suit? Well, we can start with beginners, as it performs all the research for you, an investor with particular core values, i.e. innovation, green, growth or local, low risk, as a fund includes a diverse range of investments and does not rely on the performance of one company, and time poor, similar to a beginner, leave it to the so-called experts. So let me know your thoughts. Maybe you have a favorite fund like ARK, or a favorite fund manager like Kathy Wood. Or maybe I haven't been able to answer all your questions regarding ETFs. Leave it in the comment section below. That's all for now. Thanks for watching.